Hello, in this video we will be discussing chart patterns and how traders use them. Learning to use chart patterns efficiently can significantly increase the probability of entering a profitable trade. Patterns are divided into three main categories: reversal, continuation and bilateral. Reversal patterns. These patterns signal that an ongoing trend is about to change its direction. Here are some of the most popular reversal chart patterns. The double top pattern is created at the end of an uptrend when the price movement creates two swing highs at a similar price. The head and shoulders pattern is formed of the swing highs and tells a trader that an uptrend is potentially over. The signal line here is called the neckline, drawn between the two most recent swing lows. A break of the line and the pattern is complete. Reversal wedges. Rising wedges indicate that a preceding down move has a higher probability of occurring. When reversal wedges complete at the end of a trend, they push prices in the opposite direction. Continuation chart patterns. Continuation chart patterns occur mid-trend and signal that a particular trend is likely to resume after a short pause in price action. Ascending triangle and descending triangle. Ascending triangles form when the price follows a rising trend line. The trend consolidates and doesn't make any further highs for some time. Any break in resistance is a signal for a rally. Bilateral chart pattern. Symmetrical triangle. These types of patterns can be quite tricky since they signal prices moving in either direction. In order to trade on these patterns, traders place orders both on the top and bottom of the formation. Symmetrical triangles are examples of bilateral chart patterns. Since the two sides of the triangle are equal, the price is expected to move in an equal distance to the size of the formation. Traders generally wait for a breakout here to confirm potential trend formation. They usually place a stop right beyond the opposite end of the breakout side.